Yeah, welcome back to ThinkTech. I'm Jay Fidell. This is Talking Tax with Tom every Thursday, every other Thursday. Tom Yamachika, president of the Hawaii Tax Foundation, and this is an important time to talk about tax with Tom because the legislature just closed on last Friday, and we can take stock and we can see what's going on and we can see what's on the governor's desk and get a real handle on where our tax dollars are going or not. Welcome to the show, Tom.
It's great to be back, Jay. How are you doing?
I'm good. I'm examining, what's on his desk and making my own mind up whether I would sign it or not. I'm afraid that may not have a big effect on him, though. Um, so, okay, let's talk about the tax bills that were sent to the governor by the just concluded 2021 legislature. What changes did we have, for example, in the income tax?
Okay, every year we pass a bill to conform at least part of our state tax code to the federal tax code, the changes that have happened through the end of 2020. That's what's considered in 2021. So if you can remember, there was something called the Consolidated Appropriations Act that was signed by President Trump at Mar-a-Lago just at the end of December, um, and it had some very interesting changes to the tax law, and there were even more that were contained in President Biden's first big tax package, the American Rescue Plan Act. And so, in this bill, House Bill 1041, it shows what parts of the federal acts were picked up for Hawaii tax purposes.
Anything notable?
Okay, let's kind of go through it. If I can have the first slide, please. What happened is that there were a lot of federal provisions to give people money without tax consequences, um, including Paycheck Protection Program, or PPP loan forgiveness, grants
Ordinarily,
for,
the forgiveness of a loan would be taxable
that's
as
correct,
as ordinary income. Yeah.
as ordinary income.
Yeah.
EIDL, the Emergency Disaster Loan Program by the SBA, that's non-taxable either. And the same treatment is going to be extended to the other government grant programs that the feds have going. There was one that was just announced for uh, small business grants, restaurants, and so forth. Um, and uh, and of course, something near and dear to everybody's hearts, the second round recovery rebates, which is the $600 stimulus checks that you've probably got from the feds. So we didn't do the 1,400 yet because that was 2021 legislation, and they'll consider that next year. Okay.
Hmm. Yeah, the thing with the restaurant money, that's really an extraordinary move because the restaurant industry, needs a shot in the arm. Oh, that you shouldn't use that term right now. It needs an infusion of some benefit from the government, and it apparently is getting it. And SBA is pretty excited about it. We had a show a few days ago about that, and this will really help the Hawaii restaurant industry.
Okay. Now, one of the other notable things about this legislation is what it doesn't conform to. And so let's go to the second page of this. One thing that the federal legislation did is it said, okay, when you have tax exempt income and you spend it, um, normally that's a deductible expense for your business, but they said no, we will allow you to write it off anyway, which is again a break from normal tax law, but they can do that because they're the Congress, and that's what they did. But the question then becomes, well, what are we going to do for Hawaii purposes? Are we going to do the same thing? And it turns out that if we did, it would cost the state uh, uh, 9 figures in lost revenue, uh, between 120 to 240 million. And we said, oh, geez, we can't afford that. So we are not going to pick that up. So you can see on the list, it says does not conform to allowance of deductions for expenses paid with proceeds of forgiven PPP loans for which the forgiven amounts were excluded from income. The same thing applies to expenses paid with grant proceeds and so forth. And if you're an S corporation, you would get basis for that if it was normal tax exempt income, but you can't do that for Hawaii purposes.
Well, isn't that eminently fair? I mean, you're getting the money tax-free. Now you should get a deduction. You didn't have to pay tax on the money in the first place. So why should you get a deduction for money that came to you tax-free as a grant? I mean, it seems to me that's eminently fair.
Yeah, it is, but the problem is it didn't give anybody any benefit. Why? Because you spent the money, right? And you deducted it. Then you got the grant. And if that was taxable income, you would be at zero. Well, if you get the grant income non-taxable and you can't expense the deductions, you're still at zero. So there's
Oh,
no.
I see. So you're not deducting it against anything. But if
Yeah.
I have other income, okay, and in other words, I get $1 million of regular, ordinary business income. I also get a grant. I mean, I don't think there's too many cases like this, but also get a grant. Now, I can't deduct the grant, even though I earned the other income. And what that suggests to me is it's really a problem in tracing here. How do you know if you spent it out of the first million or the second million? It's a practical problem.
Well, not really, because the way the at least the PPP grants work, they're based on expenses. So you have to incur the expenses first before you can get the forgiveness.
Okay, what about the idle grants, the EIDL grant?
Those are kind of minor. Look at $1,000 per employee. So it's probably not going to matter too much.
Okay, all right. Let's move on to other changes in the, I guess, the income tax and the state's adoption of federal changes.
Right. And the other notable thing is that for unemployment compensation, there is a provision in this year's Rescue Plan Act that says uh, that we can exclude, I think it's $10,500 of unemployment compensation received in 2020. Okay, so you don't have to pay tax on that for federal purposes. And the question is, well, what about for state purposes? And the answer is it's still taxable because we didn't pass anything to make it non-taxable. The bill that was proposed to do that got killed very early in the session, and frankly, it's a very expensive bill. It was I think $120 million.
Yeah, we need the money.
That's right. So when people got the unemployment benefits, they all were given an option, or at least so I'm told, they were all given an option to withhold uh, tax on the benefits. If you didn't do that, then you knew you were taking a risk, and unfortunately, it means that you kind of lost the gamble, and you need to make sure that the tax is paid.
Okay. Yeah. Should listen when they give you the option of making a deposit.
Right. So yeah, I guess it was kind of wishful thinking on a lot of people's part, and I do get tons and tons of questions about this. But the unfortunate answer is that no, we're not going to conform to those for state purposes.
I think the driver is that the state needs the money and is looking for every possible avenue to get the money. And these both of these things you just mentioned are ways the state can increase its own revenues.
Well, that plus there's a prohibition in the American Rescue Plan Act that says if you as a state take money and you enact tax relief, then that comes out of your own hide, and the uh, um, amount that you get from the feds may be reduced by that amount. So
Mhm.
nobody really wanted that to happen.
Is that really a threat here, though?
It could be
Mhm.
because of the numbers we're talking about. I mean, $120 million for the UI benefits or $240 million for the um, deductibility. Those are not small numbers. And the amount of aid we're getting from the feds is what, $1.6 billion, and then there's another, what, half a billion for the schools.
And what I mean, though, is the state is not creating new tax benefits for people. Um, it's not it's not passing the benefit through that way. The state is just leaving the law the way it was. It's not adopting federal changes. You think that would cause the need to return the money from the federal government?
Well, if you I mean, it's not 100% sure because the Treasury hasn't put out regs yet, but uh, if you read the law literally, it says if you enact a tax cut, uh, you're
Mm.
basically liable to return money to the feds.
Well, I think, but yeah, but it's going to look at everybody's going to have to look at the language
Right.
that you're talking about. If you enact a state tax benefit, they're just not enacting anything. They're leaving it status quo. Query whether that qualifies for a refund.
Right.
Okay, let's move on.
Okay. Another thing that happened is the notorious Franken bill that we talked about in previous sessions, uh, called House Bill 58. It used to be Senate Bill 56, uh, but it got killed in the House, and the Senate retaliated by gutting a House bill and shoving that stuff in it. During the conference negotiations, a few things got taken out of it. There is no longer a provision that increases the individual income tax rates. There is no longer a provision that drops the ceiling or the floor on taxable estates. So uh, currently, um, estates of 5.49 million or less pay no estate tax, and that's true for Hawaii purposes. And the federal ceiling is much higher. It's 11 point something million. Um, but that didn't change either. What did change is that the uh, House Bill 58 proposes suspension of some of the general excise tax exemptions, and here's what they are. Now, most of these probably won't affect ordinary people. Um, the third bullet, however, may be kind of a problem. It's the deduction for leased rent on subleased realty. Here's why that's a problem. A lot of the property here in Hawaii, you know, residential, commercial, or otherwise, is leasehold. There are a lot of big estates that have a lot of land holdings, and they didn't give up the land holdings, but they are making it available to other people, but they need to be paid for it. So a lot of shopping malls, uh, other commercial space has this property. The space is leasehold. Then you have the shopping center developer, or whoever's running the shopping center. Um, they pay the lease rent to the big estate. They collect rent from the commercial tenant. So it could be the local a drugstore, or grocery store, or mom and pop. Okay, um, if you have a full freight GET being imposed both times, that's what, 9% in most counties. We used to have some relief from that, that we gave to the person in the middle, so that it would look more like 5% instead of 9%. But this basically puts it back to 9% for 2 years. And if the uh, if there is sublease space and there's another sublease on top of that, that's another 4.5%. So it gets to be a big problem really quickly, and it'll probably affect your mom and pop stores, your um, outlets in shopping malls, your stores, um, and other commercial tenants of commercial complexes. So that has a potential to be a big problem.
Well, they'll all pay the full rate and the state will make a lot of money. So this is just another bill to raise money, isn't it?
That's exactly what it is. I mean, that's what it was 10 years ago. We did the same thing 2011 through 2013. And this time it's 2 years starting from 1/1/2022. Uh, so it'll be calendar years 2022 and 2023.
I don't know. The thing about the gross excise is it's plenary, it's ubiquitous, and people are like, they have come to accept it on every transaction, even if it results in, and this is a windfall for the state when you layer it up this way, and everybody in the chain of leasehold title has to pay full freight. That's really a way of squeezing the lemon. I wonder if there's anybody opposing this. If I was in the real estate and commercial lease business, I would oppose this bill.
Yeah, no,
Um,
there was opposition,
yeah.
um, but the House and Senate passed it anyway. So up to the governor it goes, and to see what he's going to do with it.
Well, this not to digress too far, but this we talked before about how the Fed was going to give was giving the state 1.6 billion, I think. Then at the same time, the state was doing it in tax increases. So the 1.6 billion was intended to help the state out, but the state is still doing the tax increases. And as I recall, our discussion was that the money from the Fed would go into the rainy day fund, which is really a way to just bank it. Since then, it seems like half of the money that they were going to put in the rainy day fund is now going to they're going to spend it. I forget exactly how. And so to avoid the argument that it's all rainy day fund and therefore not exactly what was intended by the Biden administration. Where is that now? Because we have tax increases, we have the 1.6 billion, we have half of the money going into the rainy day fund. It all seems like it's not exactly what Biden intended.
Probably not, but that's kind of what we have. One important thing to remember about this particular exemption suspension is on the next page, um, where I talk about grandfather clause relief. That's about 2 paragraphs from the end. The last time around when we had GET exemption suspended, they gave you grandfather clause relief if you had a binding contract in effect when the increased rates took effect, and the binding contract would be one which does not permit the passing on of increased taxes. Okay. Um, this time you have to have your contract in place 6 months before the law goes into effect. It has to be uh, effective before 7/1/2021, even though the exemptions get suspended 1/1/2022. So if you're not aware of this, you need to be aware of this and act accordingly. There is not a whole lot of time left before 7/1/2021.
But what can you do being fully advised?
Um, if if you have a relationship um, where the taxes matter, uh, you can ask for appropriate changes in your lease document or in your contract to sell property to the federal government, for example, so that your contract, as amended, contains the required provisions, um, and is in effect uh, before 7/1/2021.
You know, I think they're counting on the fact that most people will not have the opportunity for a reopening on that issue, or they won't have the negotiating position to get that change. Or
Well,
they
10
won't
years
even,
ago, there was a lot of activity, especially around uh, the sales of property to the federal government, because the feds were absolutely not interested in uh, getting an additional 4% bump on their sales. I mean, right now they're exempt, um, and they wanted to keep that way. So there was a flurry of activity, 10 years ago in 2011, where uh, different federal agencies were frantically amending their contracts to make them um, comply with the grandfather clause. That's probably going to happen again, uh, but we just don't know how fast.
yeah, or how well people will be informed. You know, a large capital concentration will have lawyers and accountants that will tell it, you know, they got an issue here. And a smaller company, a mom and pop, won't even know about it.
Yeah, and they'll find out too late, when the auditor comes knocking on their door.
Yeah.
Well, yeah, I've represented some of them, so that's what happens.
Yeah. Gee, that doesn't sound fair to me. The 6 months, it's ambush.
The 6 month ambush. Okay, and there's also a part of House Bill 58 that increases conveyance taxes for the sale of non-commercial properties.
Mhm.
So I think it's if it's between 4 million to 6 million, your conveyance tax is doubled. If it's 6 million to 10 million, it's tripled, and over 10 million, it's quadrupled. Basically, that's kind of how I saw one uh, news media outlet phrase it, and it's not exactly 100% correct, but it's pretty close. And
Is this
again,
a big revenue raiser for the state?
well, I think they think it is.
Yeah.
And one thing you got to remember about the conveyance tax is that once you hit a higher bracket, um, it's not like income tax. You see, because income tax, if you hit a higher bracket, the dollars that you are taxed on before you hit the bracket still get taxed on the lower brackets. In conveyance tax, that doesn't happen. Everything goes to the higher bracket. So there is going to be a big spike once you hit once you hit the 4 million, once you hit the 6 million, and once you hit the 10 million. Uh, and by spike, I mean you can wind up paying, $200,000 or more on $1 of additional value. If it's
Well, you got to
if
be
it's
careful about valuations. You got to be careful about what you pay. If you want to save a little money, just stay out of the next zone, you know, and negotiate the price down and everybody agree. The price should be at the lower bracket instead of the higher. I don't know if it makes that much difference. I remember when the conveyance tax was nickels and dimes. It was very cheap and it was across the board and nobody even thought much about it. I'm not sure it was well, it had to be enforceable because you couldn't record your, transactional documents without paying the conveyance tax. In fact, it was payable when you presented the documents, right? It's
still
payable when you, yeah.
still
So,
is. Yep. So that part hasn't changed.
yeah. But it strikes me is that there's a couple of things operating. One is we need the money. We're going to go to every possible tax we can. And two is that people won't object to this because if they're getting more money on the sale of appreciated Hawaii property, then they can afford it. They can afford to pay at the highest rate for everything. And I think it's just it's like finding another source of income for the state. Query: does the state need this? Does the state? It seems to me that we need really sweeping fiscal reform and tax reform, not this kind of nickel dime thing where you hope that nobody will notice that you're collecting a lot of money on something you collected very little before. Nobody thinks much about the conveyance tax. The average person in Hawaii has nothing to do with the conveyance tax. It's only for the people who are trading property.
Yeah, but that makes prices go up all around. I mean, the more,
Of course.
yeah, the more uh, tax you take out of the economic system, uh, the slower the engine's going to run, and that's kind of
Absolutely.
what we're worried about.
But the direct imposition will be on the people who are, buying and selling property. And long-term leases, right? This also applies to long-term leases.
Yes, it does.
Yeah.
I
So what
think it's
about,
5 years or more, at least 5 years or more, as conveyance tax does apply.
that's a good reason. And the burden, what? In a lease, the burden falls on, well, in any of this, the burden falls on what? The seller. Yeah,
That's right. Although it's certainly considered in the negotiation when the buyer buys it.
sure. And if you have a lease that would be for 5 years and 1 month, you probably want to make it 4 years and 11 months instead.
Well, depending on the dollar value. Yeah.
Yeah. And that's a problem for some areas of the economy because, at mom and pop, the guy at the low end, he wants a longer lease. Um, so that if you encourage the landlord to have a shorter lease, then you're taking it out of the tenant's hide somehow. Anyway, you also wanted to talk about the transient accommodations tax. What about that?
Yeah, we have a few more to talk about. I think the transient accommodations tax may merit its own show. So,
So, what do you want to close with? What do we learn from this? Where do you think the governor will sign all these bills?
um, the governor will be considering all of these bills and will make a decision probably late June, early July. I think June 20th or so is the deadline for the governor to make his list of bills he intends to veto or may veto, and uh, the absolute final deadline is early July.
Yeah, and one thing people may not realize is that between the close of the session and the time he acts on his veto inclinations, they can have their 2 cents. They can write him, call him, try to get a meeting with him, lobby him about whether or not to sign a specific bill, and that happens every
It
year. It happens,
it
and
does
it's
happen.
happening right now.
It is. What we can all do is we can be informed of what's here. Um, if you want to lobby, that's your right. But you can't lobby much if you don't have the right information. So we're trying to present the information on what happened and how it happened, so you can make your own decision about what to do about it.
Well, you've written up a lot of notes. We've seen some of them. Query, are these notes on your website? Can people look at the Tax Foundation of Hawaii website and see what you're talking about, Tom?
Yes, it's there. It may be a little tough to find, but if you call or write into us, we'll be happy to help you with it.
Okay, and they can look at this show again and again and again if they like, and they can look at the next show in a couple of weeks, where we cover more of the issues around these bills that have been passed and are awaiting signature by the governor.
Right. So just go to tfhawaii.org, um, as was just shown in the banner underneath, and uh, there's a lot of information there that you can look at, and hopefully it'll help answer some of these questions that people have.
Okay, on we go. Thank you so much, Tom Yamachika, President of Tax Foundation of Hawaii, talking to us about what do you want to call it? The cutting edge between the legislature, the governor, and you on tax. Thank you so much, Tom.
Thank you, Jay.
Aloha.